The U.S. debt ceiling. Only Congress can update it, which means the need to do so triggers regular showdowns between Congress and the White House, with the potential to erode the U.S.'s creditworthiness, destabilizing financial markets, and raising borrowing costs for everyone. Let's back up. Like many households, the U.S. government does not run a balanced budget, meaning it spends more money than it takes in. To cover that gap, the government borrows huge amounts of money. How? By selling bonds, U.S. treasuries, to individuals, professional investors, and other countries. So think of the debt ceiling as the limit on Uncle Sam's credit card, the maximum amount the federal government can borrow through sales of bonds. When the government reaches the debt ceiling, as it does regularly every few years, it's no longer allowed to borrow until Congress passes legislation to raise or suspend the limit. This doesn't change the fact that the government still has to make good on its existing obligations. Everything from Social Security checks and veterans benefits to interest and principal owed to bondholders. Once the U.S. reaches its debt ceiling, the Treasury Department is forced to take extraordinary measures, basically get creative with its accounting, such as temporarily not paying into government employee pensions. Once it has exhausted these measures and cash on hand, the government is at risk of defaulting. So how did changes to the debt ceiling, which was created back in 1917, come to have such high stakes? Some lawmakers have increasingly used the ceiling as political leverage to wrangle concessions from the other side. In the mid-1990s, House Speaker Newt Gingrich faced off against President Bill Clinton, refusing to raise the debt ceiling unless the White House agreed to offset it with reduced government spending, even though Congress itself already approved a spending that exceeded the tax revenues, which required the government to issue debt. A game of financial chicken ensued that included 2 separate government shutdowns and the use of extraordinary measures to roll over debt. Non-essential government workers were furloughed and unpaid interns picked up the slack. By the way, it was right around this time that Clinton famously wandered around a near-empty White House and became friends with a certain intern. In 2011, another fight over the debt ceiling rattled investors and led ratings company S&P to downgrade the U.S.'s AAA credit rating. It's as if Equifax lowered your credit score because you and your partner didn't pay the Amex bill because you were arguing in public over your spending habits. In 2013, the debt ceiling was used as a threat of economic disaster to achieve a political outcome. House Republicans wanted to starve Obamacare of funds. All of this matters to global financial markets because even the suggestion of Congress refusing to pay bondholders makes the U.S. government a less reliable borrower, one that may not resolve its IOUs. That could prompt investors in other countries to dump U.S. assets, including the dollar, jeopardizing its standing as the world's reserve currency and triggering a global financial crisis.